Hello, everyone, and welcome to Market Talks. I'm Ray Salmond, head of markets at Cointelegraph. Here we discuss the latest in what's happening in the markets with valuable insights from industry leaders, traders, and influencers. Our guest today is Miguel Morel, the CEO of Arkham, a blockchain intelligence company that has built a platform that provides information on the real-world entities and individuals behind crypto market activity. Here's a short video about Miguel. Howdy, Miguel. Welcome.
Hey, good to see you.
Likewise, thanks for coming on to the show today. Tell me a little bit about yourself. Like, when did you get a start in fintech and crypto, and how did you eventually transition into basically running your own blockchain analytics company?
So I grew up in Philadelphia, and then I moved to California to work on startups. I ended up working on crypto specifically because I felt that it was a incredible opportunity and a really big market. Generally speaking, when I tell people how it is that they can actually get started as an entrepreneur, I mentioned that there are two primary things that one should be analyzing. Essentially, the size of the market, and then the second one is how fast it's growing. So when I first got started several years ago, back in 2016, 2017, I wanted to analyze more of, just how big is crypto, how quickly is the market cap growing, what are the total volumes look like, and so forth. And the reality was that while at the time it was a relatively small market, it was growing faster than anything else I had ever seen. And that reminded me of a lot of anecdotes of early internet entrepreneurs when they were talking about how they got started building business in the early 2000s, where they were talking about just how quickly the internet was growing. And despite it being quite small, and some people actually believing, even though it sounds crazy to say now, some people believing that the internet wasn't going to be a big deal. The fact that it was growing so quickly meant that it was very likely to be very big very soon. And so, when I was starting out, crypto's total kind of global market cap was somewhere around $50 billion. By the time I started Arkham, it was about 100 billion, and now it's about 1.3 trillion. And my expectation is it'll go to 10 plus over the course of the life of my company. And so that was the reason why I ended up getting into crypto and how I got my start.
So, for investors getting in the game now, are we still early? There's that phrase, we're still early, you're still early, pays off to be early. Do you think people that are interested in crypto from today are still early?
The more important question is probably, early to what? What exactly should people be getting involved in? I think that's one of the areas where I won't touch, in order to not necessarily have to tell people what to do with respect to their trading and investing. But broadly speaking, crypto assets, just like any other projects or startups, they all have their own life cycle. And so there are some things that are much later stage. There are some things that are much earlier stage. And it just depends on your risk tolerance as an entrepreneur, at what level you actually want to get in for any particular asset. I think one of the more developed kind of crypto assets would be Bitcoin, right? That's one of the much larger cryptocurrencies, the largest cryptocurrency, and has been around longer than any other. And even that, I still feel is quite early relative to the sort of greater amount that it could grow to over time. I explained earlier in the interview that I felt that crypto could go from its $1 trillion market cap today to $10 trillion market cap over the course of several years. That exponential increase, that order of magnitude of growth, could primarily be led by Bitcoin, or at least I expect it to play a major role in that growth. Yes, I think other assets will also be a part of that. I think there are some assets that don't even exist today, which will contribute substantially to that growth. But overall, I still think that Bitcoin's a really great bet. And in the world where the total crypto market cap increases by an order of magnitude, it is also very likely to multiply as well. And from that perspective, it's definitely very early.
hmm So, what are the biggest changes that you've witnessed since you first started versus today? And that could be anything like infrastructure, um, I don't know, user interfaces, accessibility of data, or the ability to like actually interpret data and backtest it? Like, what would you say is the biggest change that you've seen happen in this space from 2017 to 2023?
The largest change would probably be the rise of decentralized protocols. And so, overall, much earlier on in the kind of cryptocurrency ecosystem, things were in a way, not necessarily on the layer one level, but sort of on the service layer level, significantly more centralized. And so, if you wanted to get access to Bitcoin, there was kind of a period of time where, you know, there were two ways of getting access to Bitcoin. In the earliest days, essentially, you could get access to it in a very decentralized way just by mining it. Eventually, that became too competitive. And then prior to the dawn of, let's say, DEXs, the only way you could then access it at scale would have been through a centralized exchange. Now, because of the rise of decentralized exchanges, you actually have many more people who are starting to use those products, use those services. We've seen a number of different examples of some cases where the overall kind of DEX volume of some of the major DEXs surpasses some of the centralized exchanges in terms of daily trading volume. And so I think that the rise of those kinds of services that make it incredibly easy to buy and to sell different sorts of assets just puts the crypto game on a whole nother level, because once you actually use those decentralized exchanges, decentralized services, you see how easy they are. You see how frictionless they are relative to other kinds of traditional financial products or even centralized exchanges. It becomes incredibly, appealing to remain in the cryptocurrency ecosystem. And you actually start to see more and more of the use cases that can lead you to believe about its long-term growth and the long-term kind of sustainable vision for the cryptocurrency ecosystem overall and how it compares to traditional finance.
Well said. Um, so this week, Ethereum's Shapella upgrade hard fork, it happened. Fortunately, without a hiccup, which I find to be quite comforting. Um, this allows people who are staking Ethereum to now withdraw it from the contract and do whatever they want with it. They can go and play around with it in DeFi using liquidity staking derivatives. They can swap it for USDT or USDC or even dollars. Withdrawals are open. From the perspective of Arkham, what's the primary takeaway that crypto investors and the industry should focus on now that Ethereum kind of ticked off another milestone and is basically coming a few steps closer to completing its total roadmap?
So overall, I think one of the things that was most interesting about this upgrade was the fact that there were so many people actually watching the blockchain. As a blockchain intelligence startup, our primary focus is on looking at on-chain analytics, analyzing raw blockchain data, and most importantly, giving people the opportunity to look at that data for themselves in a very easy to use kind of way. So going into this, there was a bunch of speculation in the market from a number of different investors, traders, other kinds of market participants who were very interested in knowing, what direction is Ethereum going to go in? Is the price going to go up? Is the price going to go down? Many people weren't really sure. And the reality is that one of the things that people needed to analyze in order to make better bets, better predictions about what was going to be true with that was actually the chain itself. It was analyzing how much Ethereum was staked on the protocol, and how much was very likely to be withdrawn after the upgrade happened, and that would give you a sense for the overall kind of supply and demand going into this upgrade and this merge. And so overall, I think a bunch of people actually sort of realized that they couldn't just analyze price action. They couldn't just look at CoinGecko or CoinMarketCap or TradingView in order to get a sense for the direction that this price asset was going to the price of this asset was going to move, but rather needed to actually analyze the chain to get a sense for actual supply and demand dynamics, which could be very useful in other areas as well, not just for Ethereum, not just when you have a merge, which will cause many people to be able to withdraw from lock stake ETH. And so overall, it was a learning experience for many investors and many traders. marketers and their first kind of dip into on-chain analytics and its usefulness.
Right, right, right. If you're able to, could you give a bit more kind of granular explanation on how a trader could use Arkham on-chain data to just get a perspective on how many entities are staked, how many might unstake? Is there a way to determine maybe which cohorts are in profit and not in profit? Um, I know that like centralized exchanges were offering staking services also, and like Binance, Coinbase, Kraken. I'm assuming that they would have had like near majority representation in those staking pools. So, if you're able to, could you give us a little bit more like some of the nuts and bolts of exactly what sort of on-chain data an investor should look at and how that might help them develop kind of like a vision for what might happen during and after Shanghai?
So there's two kinds of on-chain analytics that you can kind of look at. The first is the more kind of decentralized side, so actually analyzing the raw blockchain itself in order to see, how much of a particular asset is in a given address or in a given contract. The second kind of understanding that people tend to focus on is how much is actually within, let's say centralized exchanges which might not be owned. Those addresses are owned by a single entity, but the money is being deposited by a very large number of holders, right? It's not just an individual's wallet where you can say, okay, this individual holds this much Ethereum. If you look at a Binance Hot Wallet, it's a single address, but all of that money in there is actually spread, across hundreds of thousands, if not millions of people. And so it makes it kind of a little bit of a difference in terms of what access to information you actually have. So when you're actually looking at a centralized exchange, the information is significantly more opaque than if you were looking at a more kind of decentralized service or something like a DEX or an individual's wallet or an entity's wallet more broadly if they're the only person who owns that token in that particular address. And so what's important with this is with respect to Ethereum, let's use Ethereum as a kind of example use case for why you would want to use on-chain analytics. It gives you a sense for the overall supply and demand of a particular token. And so when you are trying to analyze something like price and trying to understand whether something is going to go up or down, one of the most important sort of fundamental understandings of economics is that price is primarily driven by supply and demand. How many people are on the other side to buy? At what price are they looking to buy at? How many people are on the initial side in order to sell? And at what price are they looking to sell at? What is the middle point? What is the bid ask spread? And then at some point you meet in the middle and a trade can actually be made. A trade can be made. And so with this, essentially you have the opportunity to look at the assets themselves, and you can see them moving onto these different exchanges or moving to get staked within a particular contract, or somebody is taking an action on chain in order to withdraw from a contract, and all of that is public in a way that was not previously possible. So let's say in the equity space in traditional finance, it's incredibly difficult to see order flows if you don't have access to internal servers and order book information in the way some brokerages do. Regulators, obviously, and in some cases, market makers also buy some of that order flow. However, in crypto, it's actually all completely public. And so, what companies like Arkham do is essentially we take that all of that publicly available information and we actually make it digestible, easy to see, easy to read and understand by the end user so that they can get a better sense for those supply and demand dynamics so that they can understand more about where the price is likely to head in the future.
Would you place yourself in the pro DeFi camp or the anti DeFi camp?
Definitely pro.
Okay. Um, so what's your opinion on Ethereum liquid staking derivatives? And I'll just call them LSDs from here. What do you think about those? Are they healthy for the ecosystem? Are they beneficial to the Ethereum network, or are there some red flags that raise concern for you?
I think in any world where you have some kind of asset in a very developed financial market with sophisticated market players, you're going to get more and more complicated instruments for people to be able to speculate, to be able to hedge, and to develop other kinds of financial products where they can, make profits and take advantage of those who don't have nearly as much information. And so when you have a physical asset. In this case, it's actually digital, but you can take physical delivery of Ethereum if you need to on your computer in a hardware wallet or in a hot wallet. Um, when you have an asset like that, and then you have some kind of financial product, in this case, the ability to stake in exchange for earning rewards, if there is a lack of liquidity associated with that, there's always going to be the opportunity to create, a secondary layer on top of those, locked assets with a lack of liquidity, whereby somebody can, place a bet, speculate essentially, and allow others to get access to liquidity for some kind of premium, some sort of fee that they get to earn on top, while they take some sort of underlying risk on the actual asset itself. And so, in this particular case, with the liquid staking derivatives, I think it makes perfect sense that you're going to get financial instruments that allow people to get earlier liquidity, allow people to hedge, and allow people to speculate without necessarily, needing access to the locked physical asset, in this case, Ethereum. And that makes sense for a market that is as complex and as advanced as the crypto economy is.
I'm going to extend from what you were talking about with liquid staking derivatives and your belief that, like DeFi allows for new financial experiments to occur. And, some people are going to play around with those and be profitable and others not so much. But just having the option is a net plus. I think that's what you were saying.
Yes, definitely. I think having the optionality to be able to, speculate in new ways or hedge in new ways is always going to be, the future of finance, as they say. And so I think it's super important to be able to have, the option to use these kinds of instruments if you so choose, not just have to use the underlying asset.
Right. A long-standing thing, and I guess it's not a problem, but it's a challenge that builders are working to find a solution for in crypto is utility. So, staking, I understand, gives utility to assets by equipping illiquid assets with liquidity, right? So that you can go and use them in other ways and still hold that position, whether it be a spot position or you're long on this asset or you're deriving some sort of yield from holding and staking it, but still would like to have the options to go and explore other opportunities that exist in the market. I think that's lovely. But I also think that DeFi needs to offer more beyond that, something that has like a stronger PMF and more like interconnectedness with the tangible, which I would say is traditional finance or the real world. And of course, there's people that are working on that, like with NFT-Fi and tokenization of real world assets and taking, like options, futures, treasuries, and whatnot, and bringing them on chain, giving people across the globe exposure to USTs through tokenization. Like, I think that's all incredible. And hopefully, with proper regulation, those sort of things can mainstream and, see adoption, which I think will happen in due time. But regarding staking, and especially with these Ethereum LSDs, isn't this just rehypothecation? And in my view, rehypothecation is a form of hidden leverage. And in my view, that's kind of what blew up DeFi and the wider crypto market in the first place. So, um, what do you think about that? Is it different this time, or are we going down the same type of path to destruction? Because there's no regulation in crypto still. So hidden leverage and rehypothecation, we know where that ends, and LSDs look somewhat similar to me.
I think that the kinds of things that were being done by centralized institutions in 2022 that caused the major kind of crises in the crypto market are actually fundamentally different from what's going on in DeFi as a whole right now. To kind of look at liquid staking derivatives and other kinds of things, I sort of look at it, very much similar to the traditional financial market. I think, the overall size of financial assets overall, and obviously these are pretty much just guesstimates that are put forth by economic groups. But something like $100 trillion globally of different kinds of assets exist. But then once you actually start to get into the derivatives market as a whole, and how many derivatives actually exist for these assets, derivatives of real estate, derivatives of oil, of other kinds of commodities such as gold. Obviously, there are a ton of equity derivatives as well. You actually get into the quadrillions, and now we start talking kind of funny money in this sense. So I don't think that derivatives fundamentally are something that should necessarily be regulated away, or even necessarily bad. I think that where a lot of the different problems come from is when people don't know the instrument that they are trading, or when the market kind of puts too much faith into a particular kind of instrument that is built on something more like a house of cards than kind of high quality asset, or high quality kind of underlying contract, if you will.
I totally agree with you. Appreciate you making that distinction because Do Kwon and who else was there? 3AC with Suzu and Kyle Davies, and some the other names. It's jumped out of my head. I guess I can throw SBF in there. But these guys didn't manage their risk. And when I think of Do Kwon and the whole Terra thing, and like Nexo and also Celsius, Mashinsky, all those guys, when I think about them, the phrase, if you don't know where the yield comes from, you are the yield, comes to mind. And that kind of syncs with what you said about the issue here is not derivatives existing. The issue is poor risk management or improper use of derivatives tools or leverage, right? Or just not knowing what you're getting into. So I do appreciate you making that distinction, because DeFi itself works. We see with every single one of these black swans and cascading liquidations that DeFi works. People that are insolvent get called, right? Everything works except during the USDC DPEG, things got a little bit shaky there. But generally, a smart contract is a smart contract, and it doesn't deviate in the way that humans deviate from their agreements, their contracts, their word being their bond. Those are things that we can break. So I do appreciate you making that distinction, that if LSDs blow up, it's because improper use or poorly built protocols or poor risk management being behind that. In most cases, greed, right? So moving on to on-chain data a little bit, I feel like looking at assets and subsectors of the crypto industry in isolation is pure folly these days. But I work with a lot of analysts and I work with a lot of traders, and a lot of them are still relying on the same skill set, tools, and approach within this market that they were like using in 2017. Like, guys are still using the same strategies. I know people that are like, DeFi data is irrelevant, on-chain data is just magic. It's not any sort of useful signal. It's all post analysis, and sure, backtesting and fractals are great, but it's not forward looking. I disagree with that, and I think you do too. So how has on-chain data changed the game up for traders?
In general, I think many people were using different kinds of technical analysis in the early days. I think that the kind of overwhelming lesson from this is that as a trader, as an investor in the market, you have to constantly be chasing new sources of yield, new sources of alpha, because the more time goes on that you have a strategy, the more people are likely to come into the trade, and then eventually it naturally tends toward to get overcrowded, and then afterwards, there's not any additional money left, there's not any alpha for you to get out of that. And so everyone's always constantly looking for something new, something novel that they can actually make use of, and that they can make use of over time. I think on-chain analytics now is a lot bigger than it was several years ago. I think that now, it's having its moment Many different people and large investors and traders are using on-chain analytics now in order to make investment decisions. Maybe it's not the only, tool in the tool shed. Maybe it's not the only thing in their box. They can use it as part of a more holistic investing and trading process just to provide them with additional information. It doesn't have to be the only piece of context that somebody has, but certainly it's become significantly more popular. And I think that on things can, if you have access to the wrong information, can potentially lead you down the wrong road, which is why it makes sense to, only work with the best products, with the best kinds of information, use tools like Arkham in order to get something that is very going to be very granular, very precise. You have very high confidence that the information is accurate in order to make your, different kinds of trading decisions and so forth, and in order to do diligence on trades. And so overall, I think it brings about a new source of information, a new source of alpha that hasn't been competed away yet. And that's why it's so refreshing for many traders who are looking to get into it.
Hmm. And speaking of technical analysis, in October of 2022, you wrote an opinion article at Cointelegraph where you claim that technical analysis is dead. Talk to us about why you think that's a fact.
So essentially, it was a title that was actually a little bit tongue in cheek. Naturally, I think that there are plenty of people who still use technical analysis. I think more so it was a foreshadowing, more of the fact that my belief that analyzing candlesticks on a price chart will start to look significantly more archaic as a trading strategy and as a due diligence process compared to the newfound transaction analysis that can be found with cryptocurrencies and the blockchain. Looking at candlesticks that are red and green and trying to paint lines on top of the screen, I think will eventually look to people as if it is significantly less useful than being able to see what assets people hold on chain, what their portfolio looks like, what their deposits and withdrawals look like, what kinds of swaps they're making on decentralized exchanges, and so forth. All of that information is significantly more valuable, I feel, than technical analysis. And so that article was kind of a little bit of a tongue-in-cheek foreshadowing of what's to come and the sort of overall rise of transaction analysis over technical analysis.
Do you think it's possible to merge on-chain data with candlestick charts to where candles begin to reflect some of what's behind the candles, a reflection of on-chain flow, that sort of thing? Do you think that's possible to merge the two? So I can go into
Definitely.
TradingView, look at the screen, and now what I'm seeing is more accurate signal because it reflects what's happening on chain?
Definitely, and that's why I mentioned that, I think on-chain analytics is just one part of the toolbox, and that you can use many other things in order to corroborate information, corroborate intelligence, and try to, paint a fuller picture of everything that's going on in the market, not just have one lens. Sometimes I think that, on-chain analytics can be a little bit like, looking at a candlestick chart with an X-ray, right? It's seeing behind the actual price information to what actually caused that movement. Was it significant buying? Was it significant selling? Many deposits or many withdrawals or large movements on chain that then actually later cause a price change in the form of a candlestick later on. And so I definitely think that they can be used in tandem.
Well, Miguel, that's pretty much it. If there was one thing you could say to all of the listeners, to anyone who's getting interested in cryptocurrency, what would you say to them right now?
I think overall, as I mentioned earlier, I think that things are still very early. One of the most important things that you can do is trying to find your own edge. Don't necessarily try to just copy what you see on the internet. I think it's super important to be able to do your own research, find new tools, and find new ways of getting access to alpha, getting access to intelligence. And so, for any person who's looking to get into cryptocurrency and looking to get into trading or needs to do diligence or other forms of research, I would highly recommend that they look at us on ArkhamIntelligence.com or on the Arkham Intel Twitter in order to get access to daily alpha and daily kinds of information that exists on the Arkham platform and across our socials.
Well, thank you for coming on today. Appreciate you making the time. I know you're probably starting to get a little bit tired. So it's been a real pleasure having you on.
Great, thank you very much, Ray.
All right. And thanks for watching, everyone. You've been listening to Market Talks. We are here every Thursday at 12 ET, 12 Eastern. So I hope to see you all next Thursday.